Good evening, sir.
Good evening, sir.
Matthew. All right, can we mute our speaker? Tonight we are looking at the second topic. Our second topic is business financing. That is sources of finance. The class is on. All right. Yes, Biola, what's the problem?
Good evening once again, sir. So I want to ask pertaining to the last topic we discussed. So I want to know the difference between a market value of a debt selling, and then if a debt is to be redeemed at par, discount, or premium. So that is still, I'm still having confusion on that, sir. I don't know.
Madam, that's another topic entirely.
Okay.
It's a topic that is completely not under here.
All right.
The issue of debt, the one should take you under cost of capital calculations. Is that clear, please?
Yes, we are currently doing it, I think.
Yes, sir.
So please, can you mute? So when you want to have your question, look at the topic we have taken. I've taken you capital structure. At the capital structure, I never discussed valuation of debt. My second topic is finance success. So if you are going to do bond valuation at par, at discounts, or at premium, that topic will come under cost of capital calculation. So when you get to that class, then you can bring up your questions.
56.
Otherwise, I will now leave the topic I want to do. I will now digress to another topic. All right. Please, can we mute our speaker? Ruth, Precious, Victoria, please mute your speaker. Yeah, tonight, our business is sources of financing. How do companies source finance to fund their business activities? If you look at the definition of financial management, at my first class, we define financial management as an integral part of management, a major part of company's management that is concerned with how companies raise finance, how companies utilize finance, so as to meet the objective of a business entity. Look at that nation. finance success. We define financial management. Please, just 1 minute. Yeah, hello, Misha. Yeah. Right now, I'm in class. You can come. Sorry for, sir, hold on, please. All right, sorry for that. If you look at the definition of financial management, we said financial management is concerned with how companies source finance, how you raise finance, how you use finance so as to meet the objective of your business organization. From that definition, you must understand the different method of financing. What am I trying to stress? This topic is a major part of financial management. Right. An important aspect of financial management is the choice of method of financing companies' assets. A major part of financial management is the choice of the method of financing companies' assets. Companies use a variety of sources of financing. Companies use variety of sources of financing. What are we trying to say here? Company uses different methods of financing. Company can finance their business. Company finance their business with equity. Company finance their business with debt. You can finance your business with short-term debt, medium-term debt, long-term debt. Companies use a variety of finance sources. Why? The objective is to achieve an efficient capital structure. Why do companies use different types of financing? You finance your business with borrowing. You finance your business with equity. You finance your business with short-term borrowing, medium-term borrowing, long-term borrowing. Now the question is, why do companies adopt different finance methods? The aim is to achieve an efficient capital structure. This topic is also related to capital structure. This topic is related to cost of capital calculation. The reason why companies use different methods of financing is to achieve an efficient capital structure. All right. Finance success We are going to categorize into two here. Finance success will be categorized into two groups. We have short-term finance success. Short-term sources of financing. Finance that you use for a short period of time. Finance that you can use and you are going to repay within a short period of time. So we are going to categorize into short sources of finance, and we have long-term finance sources. Please just 1 minute. Please just a minute. Let's continue. So we have classified finance sources into two. The first category is short-term sources of finance. This includes bank overdraft, number one is bank overdraft. Company can borrow money. Company can obtain overdraft facility to finance its operation. The topic is, how can companies source financing? One is overdraft facility. A company might arrange a bank overdraft to finance its operational needs. Overdraft facility is negotiated with a bank, which sets a limit to the amount of overdraft that is allowed. You can arrange, you can negotiate with your bank an overdraft facility. The overdraft facility allows you to overdraw your account up to certain limits. We know, we understand this. We understand overdraft. Now, from the bank viewpoint, from the viewpoint of the bank, overdraft facility should be used as follows. From the bank's viewpoint, bank expects you to use the overdraft facility as follows. One is, the overdraft facility should be used to finance short-term cash deficits. Overdraft facility, you are supposed to use it to finance your short-term cash deficit from operational activities. Please note that point. Overdraft facility is used to finance short-term operational need. You cannot use overdraft to finance long-term projects. Overdraft is obtained to finance short-term operational requirements. That's point one. Point number two, the overdraft bank balance should fluctuate regularly between deficit and surplus position. The overdraft bank balance ought to fluctuate regularly between deficit and surplus. What that means is that the overdraft balance must not be kept at a permanent position. The overdraft balance should not be kept at a permanent point. If you withdraw money today from overdraft, you are expected to pay back. That account is an operational account. If you overdraw the account today, you are going to use the money for your operation. When you make sales, you pay back into that account. That account should fluctuate regularly. Then lastly, the bank normally has the right, the bank reserves the right to call in an overdraft facility at any time. The bank has a right to call in an overdraft facility at any time. And the bank might do so if it believes that the company is not managing its finances and cash flow very well. Let me explain this so that you are going to appreciate the meaning. The bank should give you an overdraft. The bank should grant you overdraft. Bank is doing you a favor. At any time, bank can tell you to pay the money back. Bank can record that money at any time. If bank observes that you are not managing your finances very well, you are not managing your cash flow very well, bank will just tell you to pay back the overdraft facility. That will tell us that overdraft as a source of finance is very risky.
If I want to enlarge it,
there is no specific repayment period.
So that I can see the rest very well.
Madam, please, can you mute? Fumilola, please mute.
It's not so good. Okay.
Popola, please, can you mute your speaker?
It's not talking again. Will you stop it? You pause it.
Thank you. So that will tell us that if you want to finance your business, you can use overdraft. But overdraft facility is a risky source of financing. The bank can ask you to repay the overdraft facility at the shortest possible time. That's number one. Now, if you get to cost of capital calculation, the one will teach you how to calculate cost of overdraft. Look at the relationship now. I can finance my business with overdraft. But what is the cost of overdraft? How can I determine the cost of overdraft? That is the topic you are doing under cost of capital calculation. Number 2 method. Short-term bank loan. Short-term bank loan might be arranged for a specific purpose. A company can arrange a short-term bank loan for a specific business purpose. Unlike overdraft facility, a bank loan is for a specific period of time, and there's usually a repayment schedule. Bank loan is for a specific period of time. There's a specific repayment period for bank loan, and usually there's a repayment schedule. The bottom line is you can finance your business with short-term bank loan. A company can choose to finance its business with short-term bank loan. So when you get to your cost of capital calculation, Adejuwon will explain to you how to calculate cost of bank loan. If I finance my business with bank loan, what is the cost of this bank loan? Number 3 method, trade credit. Company can negotiate a favorable trade credit from its suppliers. Companies should try to negotiate favorable credit terms from its suppliers. Trade credit from suppliers has no cost, and it is therefore an attractive method of short-term financing. What is trade credit? You can buy raw material on credit from your supplier with a promise to pay some month later. Trade credits can be adopted as a means of financing. Assuming you are into bakery business. Assuming you are into bakery business. You can discuss with flour mills to buy flour on credit. You get your raw material on credit. Then you now convert this raw material, flour, to your finished products, bread, cake. When you make sales, you pay back to your supplier. So trade credits can be used as a source of short-term finance, and there's no cost attached to it. Companies will be willing to give you credit once they trust you, and they trust your business. Number 4 method, not debit, is debt. Debt factoring. Debt factoring can also be used as a source of financing. Now, what is debt factoring? How does this work? Companies that use debt factor to collect their trade receivables. Companies that use debt factors to collect their trade receivables might obtain financing for most of their trade receivables from the factor. You can obtain finance for your trade receivables from the factor. One of the services offered by a factor, one of the services offered by a factor is to provide finance for up to 70% or 80% of the value of the trade receivables the factor has undertaken to collect. The factor can provide finance up to 80% of the value of the outstanding trade receivables the factor has undertaken to collect. Let us illustrate this more. Let us illustrate this small. Assuming, okay, first, who is a factor? First, who is a factor? A factor is an individual or business entity that is authorized to collect trade receivables on behalf of its clients. A factor is an individual that is given the authority to collect trade receivables on behalf of its clients. Now let's demonstrate this. Assuming we have a company, XYZ. Manufacturing company. This company makes sales on credit to a customer. Sales on credit to a customer for 500 million. Our company XYZ, we sold goods to our customer on credit that are worth 500 million. This customer is to pay back, is to pay us in 6 months. We have given the customer credit for 6 months. In the book of XYZ, this transaction will be recorded as trade receivables under your current assets. This transaction will be recorded as trade receivable under our current assets to be collected 6 months' time. XYZ can decide to outsource collection of the trade receivables to an independent person. XYZ can decide to outsource collection of the trade receivables to an independent person. That independent person is called factor. Whoever collects debt on behalf of a client is called a factor. You can act as a factor. You can collect, you can go into factory. You approach companies that make sales on credit. You help them to go and collect their trade receivables from their customers. XYZ can decide to outsource collection of trade receivables called a factor. This factor $500 million on behalf of XYZ in 6 months' time. The factor will follow up with the customer. XYZ again. It is the factor that will follow up with the collection of the money. Now, one of the services rendered by a factor is to provide finance for his clients. He can provide finance immediately. Then the factor will collect. What we are saying is, this factor can provide money immediately for XYZ up to 400 million naira immediately. Provide finance for XYZ immediately. Instead of waiting for 6 months, somebody is giving you cash of 400 million now. Remember the topic. Company can utilize debt factoring as a means of sourcing finance. All right. We are still explaining short-term finance success. Finance we can obtain, we can use for a short period of time. We have explained bank overdraft. We have explained short-term bank loan. We have explained trade credits. We have explained debt factoring. Number 5, operating lease. Number 5, operating lease. Operating lease might be an alternative to obtaining short-term finance. Operating lease might be used as an alternative to obtaining short-term finance. Operating leases are similar to rental agreements. Operating leases are similar to rental agreements for the use of non-current assets, usually for a very short term. Operating lease, a rental agreement, a non-current asset for a short period. Companies that obtain the use of non-current assets with operating lease agreements. Companies that obtain the use of non-current assets with operating lease agreements avoid the need to purchase the assets and to finance the purchases with capital. If you obtain the use of non-current assets with operating lease agreements, then you have avoided the need to buy the asset outrightly and to finance the purchases with capital. Instead of buying the assets, you can lease the asset for some years. You only pay lease rental. By leasing the assets, you have preserved your cash. The cash you will have used to purchase the assets. Operating leases might be used extensively by small and medium-sized business enterprise. Small businesses, medium operating lease as a means of financing, as a means of obtaining the use of non-current assets. All right. So we have explained short-term finance success. Don't forget, it's your responsibility to advise company on the appropriate finance to use. It's part of our responsibility to advise companies and clients on how they can finance their business. Always remember, all finance comes with a cost. So I'm trying to tell you, you must understand how to calculate cost of capital. Operating lease is a capital for financing. Debt factoring is a capital for financing. Capital for financing. All right. We now move to long-term fund. The last assignment I gave the class. The last assignment. Examiner says that question was taken from ICAN part. Yes, Erabo?
Yes, sir. Good evening, sir.
Yeah, please.
Okay, sorry. Before you move on to this long-term funds, I want to ask question on this short term. 2 questions on this last, this number 4. Now you use an example of XYZ to a customer and then the factor. Now my question, the first question: what happens if there is a default of payments from this customer to the factor? Is this I don't want to know. I mean,
All right, the first
I want to
question,
ask,
what
is
happens
this
if there's a default? Second question.
okay? Second question, the factor tends to keep the 100% of the money, that is the 500 million, right?
No, the factor will collect 500 million on behalf of the client. He can't keep it.
Okay, so if we collect the 500 million, since he has already given the XYZ, the client, a 400 million upfront to do his or her business, so the 500 million that the factor is now collecting, the receivables that he's collecting, what happens to it, sir?
All right. I was actually... Now, the first question you ask, what happens if the customer defaults? What happens if this customer is bankrupt and the customer cannot pay back? Meanwhile, the factor has given 400 million loan to XYZ. What will happen depends on the terms of the factor agreements. The terms of the agreements. It's a legal contract. There are 2 types of debt factoring. You can have factor with recourse, factor without recourse. If the contract is factor without recourse and the customer defaults, then the factor will bear the loss. If the terms of the contract says without recourse, then that factor that has given loan of 400 million and the customer failed to pay back, that factor will bear the whole loss. But if the contract says with recourse, in that case, if the customer defaults, the factor will go back to the client to collect his 400 million. That is one. The second question, when the factor collects the 500 million, reasonably, the factor will take his own 400 million. He will now remit 100 million back to the client. Now, on that 400 million loan, it is possible that the loan is with interest payments or without interest payments. It's a function of the terms of the contract. But the bottom line we are discussing here is company can adopt debt factoring as a means of sourcing financing. Now, when you get to working capital management, you are still going to take a topic, working capital management. Your working capital includes stock, trade receivables, trade payables. Then at that point, Adejua will explain to you what happens here. Is that better?
Yes, sir. It's fine, sir.
Is that better?
Yes, sir.
All right.
Thank you, sir.
You're welcome, please. Take just 1 minute. We continue with the class now. So please don't hold back to ask your question. But I like when you ask me question on what I'm treating. We continue with the we are now looking at long-term funds. Finance obtained that will be used for long term. Finance we obtain. The finance company can obtain for longer time period.
Sir, we are not seeing the screen. No, me, I'm not seeing the screen. No.
I guess network threw him out. We can't see, we can't hear.
Glitch. So we are looking at long-term fund. Finance.
We are not seeing the screen, sir.
For it. We are looking at long-term funds. Finance we can use for longer term period. Some of these, what is equity funds? Equity fund. Equity fund to the business by the owners of the business. Logically, The owners of the business must provide finance for the business. Finance contributed to the business by the owners of the business is categorized as equity financing. The owners of the business are the ordinary shareholders. The owners of the business are the ordinary shareholders. In other words, money contributed to the business by the ordinary shareholders will be classified as equity finance. This money will be in the business a longer time period. This money will be in the business forever. And the owners of the business, they are not waiting for repayment because they believe that that business belongs to them. Method of equity finance. What are the success of equity finance? One is retained earnings. Retained earnings. Your retained earnings, companies' retained earnings, is part of the company's profits that is retained and reinvested in the business. Retained earnings is part of the company's profits that is retained and reinvested in the business. Companies can decide to use its retained earnings to finance its business. You can use your retained profits to finance your business. Please don't forget our discussion. How can companies source finance? Retained earnings can be adopted as a means of equity finance. There are several benefits of using retained earnings to finance our business. Retained earnings, the money is readily available. The finance is readily available in the company. The directors do not require the approval of the shareholders. Utilize risks to finance. Do not require shareholders approval. So as to you retain. Then you can't hear me. Means that my network is off. Hello, good evening.
Good evening,
Good
sir.
evening.
Can hear you
Good
now.
evening, sir. You're
Welcome back.
back. You're back now.
Somebody say we cannot hear you. Network is gone. How will you hear me? All right. We are saying that retained earnings is a cheaper means of financing because you are not going to incur issue costs. If you are to issue new shares, you are going to incur issue costs. But your retained earnings the finance is available with you. So it's cheaper to use retained earnings than issuing new shares. These are the benefits of retained earnings. However, there could be some limits to the amount of earnings available. There could be limits to the amount of earnings available for retention. What are these limits? The company might not earn large profits. When a company is not profitable, you cannot talk of retained profits. We can only talk of retained earnings if a company is profitable. Number 2 limitation. Retained earnings must be used efficiently. Retained earnings must be used efficiently to provide suitable return on investment. The directors should be able to use retained earnings efficiently to provide suitable return on investments to the shareholders. Otherwise, the shareholders can demand higher dividends. If you cannot use retained earnings to generate more earnings, then shareholder will ask directors to return their money back. You are retaining my money. Then you must use that money for investment. That investment must generate returns. Otherwise, I'm going to ask you to return my money back. Retained earnings is opposite of dividend payments. If you are doing retained earnings, that means you are paying less dividend out. Retained earnings is an opposite side of dividend payment. If a company chooses to retain earnings, that means the company will pay less dividends. A company might have a dividend policy, and the shareholders might have expectation about future dividends. What future dividend ought to be. What we are saying is retained earnings is limited or restricted by dividend policy. Your dividend policy might reduce retained earnings. All right. The bottom line here is company can use retained earnings as a means of equity finance. You can finance your business with retained earnings. Hello. Number 2 method, under equity finance. Company can raise equity capital externally by issuing new shares for cash. This can raise capital externally by issuing new shares so as to generate funds. Public companies can do this very well. Publicly quoted companies can issue shares with an intention to raise additional finance externally. So, by issuing new equity, company can source finance. There are 3 methods of issuing new shares. There are 3 methods of issuing new shares for cash. If companies are planning to raise funds, there are 3 ways company can issue new shares for the purpose of raising funds. Number 1, public offer. Issuing new shares for purchase by the general investing public. Issuing new shares for purchase this is called public offer. The public offer is issuing new shares for purchase to the general public. Let's go on with the class. Please note, only publicly quoted companies. I hope you can hear me.
Sir, you are breaking. We are just hearing you, and it's just fluctuating, sir.
All right, let's hold on first. Can you see my screen?
Yes, sir.
Yes, we can see your screen, sir.
All right, we can go on now.
Yes, sir.
We said public offer, issuing new shares for purchase by the general public. You are issuing new shares to the general public for purchase for the purpose of sourcing finance. We now said for public offer, your company must be publicly quoted. Only publicly quoted companies are allowed to do public offer. Private companies cannot issue shares to the general public. That is number one method. So don't forget, company can do public offer. You are issuing new shares for purchase by the general public. You are trying to raise additional funds. Public offer is very expensive. The cost of public offer is very high. The issue cost for public offer is high. So, public offer should be used if a company is planning to raise substantial amount of money. Public offer should be used if a company is planning to raise a substantial amount of finance. Number two method, private placing. We call it placing, to place. Issuing new shares to a relatively small number of selected investors. This is called placing. Placing is issuing new shares to a relatively small number of investors. Usually, we call it institutional investors. You are issuing new shares to a small number of selected investors under private placing. You are not announcing to the general public. A company is issuing new shares, but this is not announced to the general public. The new shares will be placed with issuing house. The issuing house will now look for selected investors that will buy the shares. Private placing, the issue cost is relatively low. A company can use private placing if the amount involved is small. If the amount you are planning to raise is a small amount, but under private placing, the new shares will be in the hand of few investors. These investors are called institutional investors. That is number two method. Number three method, issuing new shares to existing shareholders in a rights issue. Company can do rights issue with an objective to source finance. Right issue is an equity source of financing. Placing is an equity source of financing. Public offer is an equity source of financing. Right issue. We are issuing new shares to existing shareholders for the purpose of raising additional funds from the existing shareholders. Remember the topic. How can companies source finance? Yes, evening.
Yes, sir. Sir, good evening, sir. Sir,
Yeah, good
please.
evening.
Sir, please, this private placement you just spoke about now, you said the shares will be in the hand of, is it few selected investors you said, or I didn't get it. And you said it's called institutional. I didn't get it. My network was breaking. That's why I'm
Okay.
asking.
We said private placing. You can also call it placing. At times they will say placing only. At times they will put private placing. At times they call it private placement. Thing is issuing new shares to a relatively. Oh. Let me take that again. Placing. Issuing new shares to a relatively small number of selected investors. The shares are not made known to the public, not to the general public. The shares are issued to investors, small number. These selected investors are called institutional investors. Evening, is that better?
Yes, sir. Thank you, sir.
All right. We shall talk more on right issue. When you talk of right issue, okay, you recall the question we solved, calculating gearing, that involve right issue. If you are talking of right issue, a privilege given to existing shareholders to buy additional shares in the company, usually at a reduced price. A privilege, a right given to existing shareholders to buy additional shares in the company, usually at a discounted price. That discounted price is called the issue price. The price at which new shares in a right issue will be issued. That price is usually at a discount below the current market price of the existing shares. The issue price is usually at a discount below the current market price of the existing shares. We now have theoretical strike price. We also have cum right price. When a company announces a rights issue, when a company announces a rights issue, the market price of the existing shares before the new shares take place is called cum right price. When a company announces a rights issue, the market price of the existing shares before the new share takes place is called cum right price. The theoretical strike price is the expected share price after the completion of the rights issue. The theoretical strike price is what the share price ought to be in theory. What the share price ought to be in theory after the right issue has taken place, after we have completed the right issue. All the shares, after we have completed the right issue, both the existing shares and the new shares, we have a price. That price is called theoretical strike price. The expected share price after we have completed our right issue. The theoretical strike price is simply the weighted average price of existing shares cum rise and the issue price for the new shares in the rights issue. We calculated this before. Or yield adjusted theoretical strike price. Please note, all this discussion here involve calculations. Yield adjusted theoretical strike price. For most exams, examiner asks about theoretical strike price. The examiner can also choose to ask you about yield adjusted theoretical strike price. Normally, when you calculate theoretical strike price, the assumption for calculating theoretical strike price is that the new fund will generate the same return as the existing fund. The assumption for calculating theoretical strike price is that the new money we have generated, the new money we have raised from rights issue, will generate a return similar to existing fund return. Let me explain that. Remember, we said right issue. You are issuing new shares. You are raising additional new fund. You have existing fund before. You have money before. That existing fund generates return before. You now want to raise new fund. The assumption with that new fund is that that new fund will generate the same return as existing fund. We now calculate theoretical strike price. But if we observe that, or if we note that the new fund generates a return different from returns from the existing fund, if you observe that returns on new fund is different from returns on existing fund, in that case, you are going to calculate yield adjusted theoretical strike price. Look at the notes. Normally, we presume that when we do rights issue, the money from it generates the same rate of return as existing fund. That's our presumption. But if the new money raised is likely to earn a different return from the current return, then the yield adjusted theoretical strike price should be calculated. The yield adjusted price demonstrated how the market view the right issue. All right. All this discussion so far is on right issue. The last aspect of right issue, the shareholders' choices. Options available to shareholders when a company announces a right issue. There are 4 options available to the shareholders when the company announces a right issue. What are these options? 1, the shareholders can decide to take up their rights and buy shares. You can decide to take up your rights and subscribe for the new shares. Yeah. That is option 1. Option 2, shareholders can decide to renounce the rights and sell the rights in the stock market. Remember, it's a privilege, not an obligation. It's a right, not an obligation. The shareholders can decide to renounce the rights and sell the rights to the stock market. By selling the rights, the shareholder is giving another investor the right to buy the shares at the issue price. So you can choose to sell your rights to another person to buy the shares. Option 3, shareholders can decide to buy some of the shares and sell some of these shares. Shareholders can decide to buy some of these shares and sell some of these shares. Option 3 is a combination of option 1 and 2. The option 4, the shareholders can decide to ignore the rights. You can decide to ignore your rights. And you can decide not to take any actions. You can ignore the rights completely. But note, by ignoring the rights, by ignoring that right, the shareholder is likely to suffer loss in value. These are the 4 options available to shareholders in a rights issue. Please note, each of these options involve calculation. Each of these options involve calculation. All right, we have discussed equity financing. Remember, equity finance, long-term fund. Now, I want to look at long-term debt finance. Debt finance can also be long-term. Debt finance can also be what? Long-term. Debt finance can be medium-term. Debt finance can be short-term. Your long-term debt finance can be obtained by issuing bond. Long-term debt finance can be obtained by issuing bond. Bond might also be called loan stock or debentures. What is bond? A debt instrument that is issued by a company to borrow money for a longer term period. Dangote can issue bonds with an objective to borrow money. That bond issued, the issuer is the borrower. Dangote can issue bond to the public. The public can invest in Dangote bond. The investors are the lender. A bond may be issued at a premium or at a discount or at par value. A bond may be issued at a premium or at a discount or at par. I've explained this before. A loan stock may be issued at a premium or at a discount or at par. The par value is the nominal value. Nominal value of a bond is usually 100 naira or 1,000 naira. And please note, a bond is a debt instrument that is tradable. A bond is a marketable debt instrument that is used to obtain borrowing for a longer time period. Same apply to debentures. Remember the discussion. Company can issue bonds for the purpose of borrowing money. When you borrow money, you have source finance for a long term. We also have medium-term debt finance. Usually, this finance is bank loan, long-term bank loan, long-term bank loan. Companies can approach a bank to borrow money for a long term. Last diet, the examiner asks, let me even check. Please allow me to check. Do I still have the question here? I'm not sure, but let me check. The examiner asks a question here. There is too much this thing on this platform. Examiner says Differentiate between bond and bank loan. That was the question. The examiner asked the students, to differentiate between bank loan and bond. And I explained this here. Bond is a debt instrument that is tradable, a marketable debt instrument. Instruments you can use that you can trade, you can sell it, you can buy it. A tradable or a marketable instrument. For bank loan is not tradable. That is the major difference. Let's go on. That is the major difference. Also, please note, certain characteristics are peculiar to debt finance, unlike equity finance. There are certain characteristics. Okay, somebody is sharing with me. Who is this? What is this? Okay. Let's go on with the class. Characteristics of debt finance. Debt capital or debt finance might be redeemable or irredeemable debt. Debt finance might be irredeemable or permanent. When we say irredeemable debt, a debt without a specific maturity date, a debt that will not be redeemed, a debt that will not be repaid. That is irredeemable debt. But this is not common. We also have redeemable debt. Virtually all debt is redeemable. Redeemable debt, a debt with a specific maturity period, a debt with a specific repayment period. The principal amount will be repaid. The one we teach you how to calculate cost of redeemable debt. as well as how to calculate cost of irredeemable debt. We also have convertible debt. Convertible debt instruments. These are debt instruments that provide options to the debt holder to convert the debt to equity. Convertible debt. Convertible debt are debt instruments that provide options to the debt holder. It gives the debt holder the rights, but not the obligation, to convert the debt to equity. The debt can be converted to equity shares. Once this debt is converted to equity shares, the principal amount will not be repaid. By converting debt to equity, the debt holders are now part of the shareholders. In that case, the principal amount of debt will not be repaid. The interest will not be paid again, because the debt holders are now part of shareholders. Company can issue redeemable debts to source finance. Company can issue convertible debt to source finance. Company can issue irredeemable debt to source finance. Next, most of these things were tested last days. Yes, your question.
Good evening, sir. Sir, so can we say can bonds be convertible? That's my question, sir.
Your line is breaking, oh.
Sir, can you hear me now? Hello, sir.
Victoria, I can't hear you again, oh.
Sir, can you hear me?
Yeah, I can hear you now.
Okay. My question is, can bonds be convertible? Can they be an example of a convertible debt?
Why not?
Okay.
A bond is a debt instrument now. The bond can be redeemable. The bond can be convertible. The bond can be irredeemable. When we say debt, bond is a debt instrument. When I use the word debt, it means bond. It can mean bond. It can mean loan stock. It can mean debentures. She's gone. I think we lost due to net. Okay, she's back. Oh. Yes, Matthew.
Hello, sir. Good evening, sir.
Yeah, Matthew, please speak to us.
Okay, sir. What's the difference between bond and loan stock?
They are the same thing.
What about loan notes, sir?
They are the same thing. You can call bond debentures. You can call bond loan stock. They perform the same function. Is that better, sir?
Okay, sir. Thank you, sir.
You know the way every country, particularly between US and UK, they try to be original. If you get to UK now, they will tell you gearing. US we say leverage. Leverage is also gearing. Some will say this is bond. They'll say no, it's debentures. There's always this sense of originality. I don't want to copy UK. They now give it these different names, but they perform the same function. All right. Now, so please note, debt finance comes with interest payments. Yes, evening.
Hello, sir.
Yes,
Hello,
please go
sir.
ahead.
Sir, please, since you said the debentures, bonds, and loan stock are the same thing, they perform the same purpose. Can we say, since the nominal value for bond ordinarily is 100 naira per bond, can we say loan stock and debentures should still assume that nominal value?
Of course. Nominal value of loan stock, 100 naira. Nominal value of debentures, 100 naira. It's the same thing.
Okay, sir. Thank you, sir.
If, as you are doing cost of capital now, at times they will put debentures there. At times they will put loan stock there. At times they will put bond there. It's the same thing they are doing. So we said debt financing comes with interest payments. There's interest cost on debt finance. Whether you borrow for long term or you borrow for short term, whether convertible bond or redeemable bond or irredeemable bond, there is element of interest payments. These interest payments enjoy tax relief. This interest payment enjoys tax relief. The tax relief makes debt capital cheaper than equity capital. Also note, debt finance might be secured against assets of the borrower. debt capital. Borrowings might be secured against assets of the borrower. When a debt is secured, the lender has the right to seek repayment of outstanding debt out of the secured assets. When a debt is secured, the lender has a right to seek repayment of the outstanding debt out of the secured assets in the event that borrower fails to pay. Borrower fails to make payment for interest and principal repayments. What we are trying to say is, if a company wants to use debt finance, you want to borrow money, you are going to check, do you have non-current assets, tangible assets that you can use as collateral? The lender might demand collateral for you. That collateral provides second source of repayment in case the borrower fails to pay. But when a debt is unsecured, there is no second source of repayment in the event of default by the borrower. So we are going to note that we can finance our business with borrowings, but the lender is likely to demand collateral security. Also, please note, with debt finance, whether secured or unsecured, the borrower is usually required to give certain undertakings or covenants to the lender. Debt finance comes with loan conditions. There are conditions attached to the borrowing. If you choose to finance your business with borrowing, you are going to bear in mind, borrowings comes with conditions. These conditions are covenants that must be fulfilled. These conditions might not be favorable to the company. All right. We also have Islamic finance. That will be tonight. We are not going to take this tonight. Islamic financing is part of your syllabus. What are the methods of Islamic financing? We can compare Islamic finance with conventional financing. That will be today, not today at all. All right. So also let me quickly add, preference shares is also a source of financing. Preference shares is also source of financing and is long-term financing, long-term fund. Preference shares is also source of financing, long-term. Now the question is preference share equity finance or debt finance? The last assignment I gave, some few students were confused. Should we treat preference shares as part of equity or debt? Is preference shares short-term finance or long-term finance? Please note, preference shares, we also call it preferred stock, a special form of equity. Preference shares. Thank you. It's a special form of equity. Preference shares capital is a long-term fund. Preference shares capital is a long-term finance. If you look at the law, looking at legal form, according to company's law, preference shareholders are part of equity. Law regards preference shares as part of equity finance. Equity shares as part of law regard preference shares as part of equity finance. But accounting standard, the accounting substance shows that preference shares is debt financing. If you look at the accounting substance, preference shares is taken as debt finance. What are these substances? Preference dividend is fees. Just like interest rate is fees. Preference dividend is a fixed rate, similar to interest on debt. The preference dividend must be paid before payment is made to the ordinary shareholders, just like interest. The interest on debt finance must be paid. When a company fails to pay preference shares in a particular year, this can be carried forward to future years. If, for example, there is not enough profit to pay preference dividends. This particular, that preference dividends can be taken to future year, just like interest. If you don't pay interest this year, that interest will be paid at future period. Looking at the substance of this transaction, accountants, we look at the substance of the transaction, not the legal form. Substance over form. So preference shares capital is classified as part of debt financing because of the substance surrounding preference shares. All right. Any question? We have like 13 minutes. Afolabi Kayode, any question for us?
No, sir.
All right. Within 10 minutes, let's look at it. It's a theory question, so don't bother. The class will still close by 11. Cynthia.
Okay, good evening, sir. My question is, preference shareholders, are they different from the regular shareholders we know?
Yeah, they are different. So let me expand your question. That preference shares is a special type of shares, different from the ordinary shares. Ordinary shares, the company may not pay you dividends. If you are ordinary shareholder, you are the owner of the business. You might not receive any dividend payments. The ordinary shareholders take all the risk for the business. Preference shareholder is a special type of equity that give you some preference. What are these preference? Is that you are going to get fixed rate of dividend. Whether the company makes profit or not, they must pay you that dividend. And your dividend must be paid as preference shareholder before paying dividend to the ordinary shareholders. So they are different. Cynthia.
Yes, thank you, sir.
Matthew. Yes, Matthew, you need to unmute.
Yes, sir. I want to ask, now, since preference share is a special type of share, now, under exam condition, let's say now there's some question that we ask to make reference to the equity. So in this case now, the equity will not be ordinary share as the reserve. will not include preference share. I want to clarify that.
At a point, I can't get what you are saying.
Okay, what I'm saying is this. Can you hear me? Can you hear me now, sir?
Go ahead.
Hello, sir. Can you hear me now?
Please go ahead.
So what I'm saying now is since preference share is a special share, when looking at the equity of the company, that means we are considering only the ordinary share and the reserve. We won't include the preference share. I want to clarify that, sir.
Of course. Preference shares is part of debt finance. You can add it to ordinary shares. Preference shares is to be added to debt capital. I hope that answers your question. All right, look at this question.
Yes, sir. Thank you, sir.
You can
yes,
take
sir.
it home. Badejo Limited, a medium-sized company, is currently considering a major capital investment project for which additional finance will be required. It is not currently feasible. It is not currently feasible to raise additional equity finance. Consequently, debt finance is being considered. The decision has not yet been finalized whether the debt finance should be short or long term, and it is to be a fixed or variable rate. The finance controller has asked you, as the company's accountant, to prepare a report for the forthcoming meeting of the board of directors. Look at that scenario. The company requires additional finance for a major capital project. Currently, we cannot get additional equity, so we have to use debt finance. We are not sure whether to use short-term debt finance or long-term debt finance, whether the interest rate should be fixed interest rate or variable interest rate. So the financial controller has asked you, as the company's accountant, to prepare a report for the forthcoming meetings of the board of directors. Prepare a draft report to the board of directors, which identifies and briefly explain the main factors to be considered when deciding on the appropriate mix of short, medium, and long-term finance. What is the factors we are going to consider? If you are looking at appropriate mix, how do I combine this? My short-term fund, medium-term fund, the B part, also explain what are the practical considerations which could be factored in restricting the amount of debt which badger can raise. What are the factors that can limit your level of borrowing? This question was texted ICAN theories. So go on with it. Assuming you are the accountant, management asks you, should we finance this business with short-term fund or medium-term fund or long-term fund? What are the factors that will determine how to finance our business? The solution is here. All right, I will stop here. After the class, I will share the material. You can go through it. When we meet next week, by God's grace, we shall pick it from here. All right, any question? Yeah, Matthew.
Hello, sir. Can you hear me?
Yeah, please, you can go ahead now.
Okay, mine is not a question. It's just an appreciation of your way of presentation, and the find out that from the time you start the class to the end, your tempo is maintained. I begin to say, whether this is the way you talk or this is your style of lecturing, because even though you are feeling sleepy because of the tempo of your voice, your eye will be shining, looking at it. So, an appreciation, sir. Well done, sir.
Thank you, sir. We appreciate that. Thank you. All right, may God give us a better understanding. I will be checking out of the classroom. By God's grace, we meet next week.
Thank you, sir.
Good night.
Good night. Good night, sir.
Good night, sir.
And God bless.